For years, the cryptocurrency market was defined by one word: speculation. Retail traders, memes, 100x promises, and violent price swings dominated the narrative. That era is now decisively ending. According to Sygnum Bank's just-released Future Finance 2025 report, a survey of more than 1,000 institutional and professional investors across 43 countries, we have crossed a historic threshold. For the first time ever, portfolio diversification, at 57%, has overtaken short-term return potential, at 53%, as the primary reason institutions are allocating to digital assets. Let that sink in. The main driver is no longer, how fast can this go up, but rather, how does this fit into a multi-asset, globally diversified portfolio alongside equities, bonds, commodities, and real estate. Fabian Dorey, Chief Investment Officer at Sygnum, summarized it clearly. We interpret the findings as evidence of crypto assets growing into a strategic, long-term asset class, with unique value drivers and risk factors. The numbers reinforce this maturation at every level. Over 60% of respondents plan to increase their crypto allocations in the next 12 months. More than 80% now view Bitcoin as a viable treasury reserve asset. 70% believe that holding cash instead of Bitcoin represents a high opportunity cost over a 5-year horizon. 91% of high net worth individuals surveyed agree that digital assets are important for long-term wealth preservation against fiat debasement. This is not retail FOMO. This is sovereign-grade balance sheet thinking. Institutions are not simply buying and holding spot Bitcoin. They're using a mix of advanced strategies, from simple direct token exposure, which 76% prefer, to exchange-traded products, tokenized real-world assets, yield-generating DeFi positions, and even fully managed investment mandates. Over 70% say they would immediately increase allocations to ETFs if staking were permitted inside those wrappers. What enabled this pivot? 3 structural developments: regulated infrastructure, spot ETFs in the United States, MiCA in Europe, licensed custodians, and institutional-grade lending and staking protocols. Declining structural volatility and deeper liquidity, which allow billion-dollar trades without shattering the market. A new generation of crypto projects that finally understand that serious capital demands radical transparency, public vesting schedules, enforced lockups, multi-sig treasuries, and compliance-first token launches. The result is a self-reinforcing loop. The more institutional capital enters, the more the market behaves like traditional finance. The more it behaves like traditional finance, the more institutional capital is willing to enter. We are witnessing the exact moment when cryptocurrency stops being an alternative asset class and starts becoming a core component of global portfolios. The speculation era is not completely dead. Retail will always chase momentum, but the center of gravity has permanently shifted. The adults have arrived, and they are here to stay. If you found this analysis useful, please give the video a like. Consider subscribing for weekly institutional level updates. Thank you for watching, and I'll see you in the next one.